What is going on, everybody? Welcome to the Daily Stock Market Brief. Today's episode is a weekly recap. I am doing it a tad different. I'm going to be talking about opportunities and then the risk. Okay, so I'm breaking it up into two sections and I'll kind of clarify my thoughts in the conclusion section. Before we hop into today's episode, I want to thank the patrons that keep coming in to support my channel. 671 active patrons as I moved from my full-time corporate job over into doing this full-time on YouTube, trading and investing. This right here has been a big help. So thank you so much for supporting my channel. Why I am in this transitional period, going from 12 to 15 years of corporate life in the telecommunications industry to self-employment. It's crazy. I have two different tiers on my Patreon. I have a $4 per month that supports my work, and then the $9 we just recently set up the Discord there, and that's where I post trade ideas, where I posted today just quite a bit of different chart setups that I really like, that really feed into this opportunity section, which we'll be getting into. But also we have a Discord with a lot of really great traders in there that have been posting some excellent setups. So that's only $9 a month. And to be quite honest, I've put in a lot of work every single day on both the Discord with my trade alerts and then also those charts and research and putting it on there for $9 a month. It's in my opinion, it's well worth it. Let's hop into today's show. All right, everybody. First, we're going to start off with the opportunity section, and then we're going to be going into the risks and then commodities. I forgot to mention that. So let's just hop right into it. So first off, we're looking at the 11 sectors in the S&P 500. This is the weekly performance of them, okay? So what I'm looking at right now is we're looking at the top three, okay? Healthcare, real estate, and tech. So technology has started to find a little bit of strength this last week. Is that a trend change? Perhaps, and we'll get into that. But let's look at the bottom of the weekly of the sectors right here, and you can see financials, materials, industrial. So this to me is quite interesting. If I bring up a rotation chart, what I'm seeing here still is I'm seeing some defensive names to the left that have been improving, but they're kind of aiming down. Now the crosshair right here, this right here, you want these sectors to be on the right hand side. That's typically the stronger side here because we're looking at relative performance of the S&P 500. But as you can see, these ones have been improving. Now, something to note here is we're starting to see energy kind of start to curl up right here, communications, which makes up a big percentage of the SPY, and then we have technology that has been rather lagging, but we're starting to see the tail move into that improving sector. So I'm trying to really kind of figure out here, okay, so what should we be looking for in the week ahead? Where are our opportunities for potentially longer than the week ahead? Well, we had the CPI data out. When the CPI data was released, interesting stuff was taking place with the yields, both the 30-year, the 10-year. You can see right here is the 10-year and the 30-year here. And what we noticed is that the yields started moving south, right? We closed at 1.47. Okay, and that's a first time below 1.5 for quite a while actually. So a few months there. So this to me was interesting. And then also if you look at the 10s and 2s, the spread, we kind of broke down through this little level of support. So during this week when the yields were going down, you have to take a look at the sectors. What sectors were performing? What were lagging? Well, I just talked about that from the weekly standpoint, but you can look here at financials. This week in financials, yes, we're an overall pretty strong uptrend. However, you can see here we've been, as the yields were going down, financials were kind of seeing some stress. Now, we know that financials have been seen as monster run-up, and they've been building a little bit of a negative divergence as momentum has been slowing too as well. So perhaps if yields continue to fall, it does make sense for the banks, you can look at the BKX or the financials here, to maybe take a little bit of a breather, maybe reconnect with the 50 SMA or consolidate sideways. It doesn't mean it's going to completely fall apart, but if the yields continue to drop or hold at that lower area, perhaps we're going to see a little bit of a pause in financials, some healing or some consolidation, before we see the next move. Now, meanwhile, while the yields were going down, technology, you can see here, the Qs, we'll just look at them, you saw a pretty significant up move. Now, What's interesting here to point out is that we have made a pretty aggressive move. It looks like it's ready to take the all-time highs. We actually were talking about them in previous market briefs, but there is a band of resistance right up in here that you need to be mindful of, okay? So you don't necessarily want it. Well, first ask yourself, like, just where did it come from? We came from right down here to basically straight up to up here without taking a breather. So if you're going to buy a strong move into this area of resistance or on the breakout without it consolidating or maybe pulling back and then going, that might not be the greatest idea, because there seems to be a little bit more risk involved at that point than there is reward. You want to see the market move up, consolidate maybe, and then break out. Okay, now this area, this trend line plus this area of resistance means to me that, yeah, maybe the market can go shoot over it and then take out that all-time high and then potentially head lower, especially if yields continue to kind of slowly fall or potentially go a little bit sideways. If I zoom in closer to the Qs, you can see here on the 15-minute time frame, rising wedge pattern on a negative divergence. So what I would like to see here is potentially maybe an overthrow, and then it comes right back down, reconnects with the 5-day moving average, where this volume shelf profile is, maybe just in that zone up here around 336 to 338, and then maybe find some steam to press a little bit higher too. That's always a possibility. But let's look more in depth to the Qs here. So, or technology, sorry. I'm gonna zoom in on technology, because technology seems to do very well when the yields are going down. So from a weekly time frame, we're looking at what makes up the technology sector here. So we have the different industries, okay? Renewable, software, computer services, those are leading the ways. So if you want to play into momentum and you want to trade where there's strength, these are some good names right here. So you'd want to look for individual stocks within renewable energy, software, computer services potentially, which is just an idea. Now, semiconductors this week specifically were relatively flat. They're consolidating, because if you zoom out and you look at a month performance, they were actually one of the strongest, along with renewable energy. So these right up here, these top three would be ones to really pay attention to going into next week. We have software, semis, and renewable energy. So semis, for example, on the weekly time frame, made this huge run, and now, yeah, for the last, since 2021, basically we're going sideways, just consolidating right here. So if we start pressing higher and break through this resistance, semiconductors can really, really see a lot of strength take place. We do have that overhead resistance. It's consolidating nicely. So that's a good sign. If we zoom in on the 15-minute time frame, the price action, it's above the 5-day moving average. It's rather flat right here. So if we start taking out maybe, 253 or potentially these swing highs right here at 250, 250 and get above that, that could be a very good sign for semiconductor stocks, some of which that are on my watch list that I posted on the Discord. Now, if it goes straight up, maybe not the best time to get in. You might want to see it, move up there, consolidate, maybe, just pull back a little bit and so forth, and let the market kind of breathe a little bit before just, a completely vertical move. Completely vertical moves can end up like this. Like, see, we had that gap up, ramped up higher, and then it just came right back down and reverted. Here too, boom, big move up, but then it had to breathe. This gap up, boom, to the downside. Strong move to the downside. So you want to see it slowly but surely incline here, and you want to see this 5-day moving average start to turn upwards as well. Now, we talked about renewable. I started looking into solar, and this is just one example of a potential play here. TAN, now this is an ETF. Now, they have been getting, a lot of solar names have been getting completely obliterated. However, some of them are firming up right here. So this is the 15-minute time frame. Nice little bull pennant pattern with an inclining 5-day moving average right next to a nice volume shelf profile. So if we start breaking out of this previous swing high of around 80, this can easily go tag 81 on the 15-minute time frame. I haven't zoomed out to the daily. I didn't bring that chart in here for you, but this to me looks like it's being pretty constructive here, trying to turn back up. And if I look at another opportunity is the small caps. Small caps recently broke out. Now we're right here at this upper band of resistance, but it's been consolidating, after this big run up in November, it's really just went sideways. So this right here, this pattern did look like a kind of topping type pattern, but these advanced head and shoulders, they've been very unreliable this year so far. So what we're seeing here is some strength coming in. Now it's taking time to consolidate. If I zoom in on the 15-minute time frame, you can see it's an inclining 5-day moving average. Price is above it. This could be a bear flag right here where we crack down and then maybe potentially head higher. But what I'd like to see here is a little bit more consolidation and then a crack above 233. And I think that the IWM and various small caps, we can consistently see some larger moves. Now it's time to talk about some risks though. Okay, so I get you all jacked up. We're all ready to go. Let's go full bull. But let's dial it back a little bit and start looking at the risk factor, because I know a lot of professional traders I know that are currently signaling it's time to start putting on some protection, and I'll show you why that could very well be the reason. Now, protection could be in various different ways. You can have you can start getting put protection, right? You can do advanced strategies around the VIX. You can just be more in cash, right? You can get into tips. There's a bunch of various different ways. I'm not going to get into all of that, but I'm going to tell you the risks that I see. First off, the VIX. We got crushed today, right? VIX crushed Friday. We had the other day too. As the market's pressing these all-time highs, the VIX is still relatively high. Now, the risk here on the VIX, we're looking at 1, 2, 3, 4, 5 open gaps above us. Okay, so 5 open gaps above us, that's not the greatest sign. Typically, these gaps do get filled. So at what point will we maybe see this spike here in the VIX? On the daily time frame, you can see here it's wedging very tightly right here. We have still 2 gaps beneath us. You can see right here the RSI, it's not doing it as much here, but it was kind of curling itself up. And every time we get these little curls here, we can see some pretty significant spikes, which can very well shoot us up to around potentially 2750 here, and then we start heading back down. So that's a risk to be aware of. Another risk here, we're looking at the S&P 500 on the daily time frame. Very bullish context overall, but just note the breakout of these all-time highs, it's not really getting going yet. And it's doing these all-time highs on some of the lowest volume of the year, which is also a little bit of a concern. Another concern is this candle right here. The candle, look at the 5-day moving average has been acting as a very strong support. This daily candle could be a potential hanging man candle. It would be bearish. It needs confirmation, but that's just the risk. From a weekly perspective, look at just how tight this VXX pattern is forming this wedge here. And we've done it before. And when we break out, we've seen some pretty significant moves to the downside. If we do get cracked down to the downside, 4,000 to around 3,900, 3,850, that zone in there would offer up just some excellent opportunities to play a long position, in my opinion, to catch a bounce. Also to note, the RSI in the weekly time frame, negative divergence, and it's getting to that overbought territory. It's above now 70, which it's bullish as the market's pressing all-time highs. It's innocent until proven guilty, I guess. And if you look at the cues on the 15-minute time frame, we already discussed rising wedge, although it is on an inclining 5-day moving average, so we won't spend too much time on that one. Meanwhile, the NIMO breadth, and still that negative divergence there is building. That can get resolved rather quickly if the market wants to continue to press higher and we get some breadth supporting it. That's totally fine. Another thing to call out is transports down right on the week as the S&P 500 pressed all-time highs. We have the crossover that took place right here, bearish crossover. Volume is lacking though. So that's interesting from a weekly perspective. So that means to me that, selling pressure we haven't even seen what selling pressure looks like. When we get these big down weeks like this, look at the volume, boom, big uptick. So this could be just a period of consolidation, but we are overextended on larger time frames, which I've already pointed out previously. We are now below the weekly 5 EMA2 as well. And the divergence between transports and the Dow Jones, for example, if transports are heading down, but yet the Dow Jones is relatively high, or the S&P 500 continues to press higher, that divergence is very worth noting. It's something you don't want to be just overlook. Another thing to pay attention to is this current divergence that hasn't resolved itself yet. The S&P 500 continues to press higher. Meanwhile, the ratio between the S&P 500 and the TLT has made a lower high, and the S&P 500 went higher high. And these typically resolve in periods of consolidation or a minor pullback. Another thing that I want to call out is the dollar. There's been an inverse correlation between the dollar and the S&P 500. All right, so when the dollar breaks down, the S&P 500 goes up. That's been the correlation. Correlations change, so you don't want to put too much weight onto any one thing, but it is still worth noting we had a big up day in the dollar, and we saw a down day in gold, so that correlation held true. Meanwhile, the S&P 500, it actually pressed an all-time high. So nothing actually took place. Now, what happens if this falling wedge does continue to break out? I do want to point out a potential inverse head and shoulder. So a neckline breakout could be right at around 90.75. And if that's the case, then we potentially head higher. And if it heads higher with a strong rate of change, that might then affect not only gold, maybe potentially silver, various other commodities, and equity markets. So that would be the risk. From a defensive standpoint, I'm seeing utilities flag out right here on the weekly time frame, and they were up 1.1% on the week. Utilities, if we start breaking out of this flag, we might be able to take out this previous swing high and head higher, and that to me shows that the market would be moving more stronger into the direction of defense. And as we saw here, you can see XLU was in that improving, and if it starts flattening out and starts moving like real estate over here, that could be a little bit of a warning sign, because during this period, September through October, November, where we saw all that chop, we saw this very similar relative rotation graph take place with the utilities and consumer staples there. Okay, the next thing I want to call out is the lumber to gold ratio. I plan on bringing Michael Guyad back to talk about the markets and what his view and his take is going on, but from his indicator, the lumber to gold ratio, we are now at 11.77%. We are just dropping down potentially through zero. Now this can change and we can head right back up, especially if lumber starts catching a bid. But just note, when we cross through that becomes one of those moments in time where you're like, okay, maybe I should take my foot off the gas. It doesn't mean a crash is going to take place, but the conditions for the market to see increased volatility greatly do increase while looking at both lumber and the gold ratio. The other factor here is we're looking at the CPC, the total put to call ratio. We smoothed this out. The black line is a 10-day moving average. When it crosses above 0.8, it becomes our quote unquote sell signal, where it's also, hey, take the foot off the gas a little bit. We are still not there, but notice the daily spike, a couple of spikes here moving in the northern direction, and we're starting to see this 10-day moving average curl. That could be temporary. We've seen it go up before and then start heading back down, but just something to note. Now, when it crosses through the red line, you can see from the bottom to the top. So when it has to cross from beneath through above, you can see the market put on pause. It consolidated and then went higher. Here, same thing, went a little bit lower, but went higher. Here, really just went sideways. Right here, pretty spot on, big move to the downside. And then right here too, big move to the downside. Right here, pretty big move to the downside, and it also marked off the 2020 pandemic move as well. Let's hop into commodities now, okay? That's enough about risk. Commodities, oil continues to press higher here. High for the week was 71.24. Close for the week was 70.91. So we almost closed right on the high. The RSI is getting a little frothy here, and we're disconnected from the 5 EMA. This to me says, okay, we might be taking a little bit of a breather here soon. It's getting a little frothy. And if you look at energy, the XLE, these last couple of days have been a little bit all over the place. We've been getting gap ups and then rollover. This one wasn't a gap up. This one, I can't tell. It looks like a little gap up, and then it rolled over too as well. So energy is taking a little bit of a breather here. That's what I am thinking. So the energy names, there are some very good setups out there, and I'm paying close attention to them. I'm in an energy name right now as one of my swing trades, but it might be taking itself a little bit of a snooze before it gets going. Price percent oscillator here too is crossing over. It looks like it's going to be a bearish crossover. Overall, though, it's in bullish context, right? We're above the 20, above the 50, above the 100 and 200-day moving averages. So that's something to note. That's a good sign. It's just it's just a little frothy right here. Let's take a look at Bitcoin really quick. Bitcoin broke down through this symmetrical triangle. We said, okay, the hammer candle was forming. Might see a big move to the upside. This trend line, this downtrend line here, is still acting as resistant at this particular point in time. I find a couple of things interesting here. So, this looks like it's strengthening up, but it's overall, a lot of damage has already taken place. So, if we get a break above it, awesome, but it still has a lot of work to do. I am paying close attention to this ratio, Bitcoin to gold. We call it the Sailor to Shift rotation. And when it came down here, we're noting that, okay, when the rate of change between Bitcoin and gold get this low, we see some pretty decent bounces. And we're seeing the weekly candle here form a nice hammer candle, so potentially we might see a bounce. And if you pay attention to the rate of change, we're now at minus 21.64. You want to see this cross above 0. That's part of the whole strategy. You don't need to. This is, just something that I'm tracking as of right now. It's very new. But if it crosses above 0, then that would be the quote unquote buy signal, or partial buy signal. Then you want to see it crack through, break above the high of the previous weekly candle. So I'm going to be keeping a close eye on this. This doesn't mean anything at this particular point in time, but it's worth noting. Now, what I find interesting here is that Bitcoin's pressing higher. So my thing is, okay, well, I feel like Ethereum would be the opportunity. That's what I said, but Ethereum has been breaking down as Bitcoin has been rising, and they typically work hand in hand for the most part that I've noticed. So when you see big moves in Bitcoin to the downside, I've seen big moves to the downside in Ethereum. And if you see a big move to the upside in Bitcoin, you see a big move to the upside in Ethereum. So right now, I'm not too sure who's on the right track. Is Bitcoin just catching a bid because of the country, what country was it? El Salvador? Venezuela? I can't remember. Is adopting it. I didn't read too much into that, but maybe perhaps, that's one of the reasons why we're seeing the bid in Bitcoin, but not Ethereum, and Ethereum's breaking down. Or maybe that's just the market pricing in that information. Ethereum, on the other hand, is what Bitcoin may have been doing if that wasn't the case. And perhaps Bitcoin, once that little hype dies off, perhaps is going to just follow this path of Ethereum and head a little bit lower. I don't know. I don't have that answer, but all I can see is the chart, and the charts look like they're breaking down, both from a perspective in Bitcoin. I mean, yeah, it's catching a bid right here, but this looks horrible. And then Ethereum does not look all too hot here as well. Now, if Bitcoin wants to continue to press higher, I think that Ethereum would benefit eventually from that. I don't know at what point, but I don't see why, if it comes down to 2,200 and Bitcoin continues to press higher, perhaps that's when Ethereum starts to make a move. The last thing I want to talk about here on the commodity section is silver. Silver has been in this tight range here for 1, 2, 3, 4, 5 weeks, and if you expand it even longer, we're just where we were here in mid 2020. This looks good so far. If we start seeing strength in the dollar, though, that might put a little bit of pressure on silver, perhaps. So that's something to pay attention to. It looks like it really wants to get above this band of resistance and then try to take out 30. I know the movement, the Wall Street's silver crowd and the silver squeeze, it's building some momentum, getting a lot of members every day. So that's great, but it's going to take a lot to to do anything like that. That's just my opinion, but it is still trending really very nicely right here. We have the inflation coming in higher than expected, so perhaps we do get a breakout eventually. If the dollar finds some strength in the meantime, maybe perhaps we continue to doodle around in here before breaking out. But overall, it's looking strong. It's just holding up to right below this area of resistance. All right, everybody, time to go into the conclusion section. So just to wrap up my thoughts, what am I looking for going into next week? I'm looking for strength in various sectors or industries. So I think that the Qs want to press higher. Okay, so we talked about the Qs. However, if you were to buy the Qs up here, we're running into an area of resistance. So we had to take a look into the sectors, and we look from 1 week and a 1 month. Renewable energy, there's been a lot of beaten down names. Maybe there's more room to run there. There's some good stock setups that I've seen. Semiconductors is another name that might very well catch a bid. So those are some things that I'm looking into. As far as the event risks we discussed, look, it seems to me like a lot of people and a lot of professionals are talking more and more about positioning themselves a little bit more defensively or adding on some protection. So that can be an option as well. The way that I add protection, very rarely will I add sometimes I'll add put protection. However, what I like to do is just reduce position size or be more in cash. That just lowers the volatility of my portfolio overall, and that's kind of what I've been doing. I have some high beta names For the most part, I'm like in 5 full-size swing trades or 4 full-size swing trades right now, and I have some very speculative names that are pretty much minuscule. So that's my personal take. So if we start seeing the market pull back a little bit, my overall portfolio is not really damaged at all, and I get to have some dry powder on the sidelines for when I see some important setups. But I'm still long various stocks, so if the market wants to continue to press higher, I have some high beta names that can really benefit from those moves. That's all I got for you on today's episode, everybody. See you later.